You are listening to Money Managers with Marc Guzman on the Marc Guzman Podcast Experience. Welcome to a new program and spin-off from the Marc Guzman Podcast Experience called Money Managers with Marc Guzman. The focus of this podcast will be on the world of money and wealth management. Anything you own has a determined value and is considered to be an asset, such as boats, cars, real estate, stocks, ETFs, shares within a business, venture capital, and of course, cash in the bank. Managing one's own assets can get to be time-consuming and difficult when trying to understand the various investment markets and how to make the right decisions. In this program, we will introduce you to the top money managers who possess a wide range of skills with the goal of gaining a larger understanding of wealth management, investing, and market trends. At DeYoe Guzman Asset Management, we specialize in residential and commercial real estate management and expanding our services to portfolio management and venture capital. We believe proper wealth management is key to successfully creating the future you desire. Today, our guest is Jonathan DeYoe of DeYoe Wealth Management in Berkeley, California. A native of Grand Rapids, South Dakota, Jonathan moved to the Bay Area in 1994. After an interesting start to his career, Jonathan spent time working for Morgan Stanley, UBS Paine-Webber, and Salomon Smith Barney. In 2001, he founded DeYoe Wealth Management with the goal of holistic wealth management. Merging his independent financial advice with his own brand of top-notch customer service, Jonathan has built a firm with assets under management of over $250 million. After this episode, be sure to check out his book, Mindful Money: Simple Practices for Realizing Your Financial Goals and Increasing Your Happiness Dividend, available on Amazon. So, Jonathan, thank you for being on the podcast, and I'm really excited to have you here on the show because we're transitioning into, I'm not sure if you've seen some of the episodes on my podcast or listened to some of the episodes, but we typically interview or have interviewed people local to the Bay Area that have done amazing things or started amazing businesses for the community. And now we're transitioning a little bit into wealth and asset management niche for the podcast. And it kind of ties in with a little bit of what we do here at DeYoe Guzman Asset Management, and where we mainly manage residential properties for clients. And so I wanted to have you on the show, and you have a very interesting background where you got into Buddhist studies initially, and then you switched over to financial services. So why don't you explain a little bit how that originally happened and what made you go from Buddhist studies to certain financial services?
Sure. Well, first of all, Marc, thanks for having me. I'm on quite a few podcasts, but most of them are not local, so I really appreciate being on someone's local show. That's really cool. Second, this seems like it's kind of a good pivot because I think that financial planning and wealth building is actually something you can do, and then once you become successful, you can actually become significant by giving back into that community. So I think this might be a good episode pivot between great things for the community and sort of building wealth and asset management. So I'm happy to be part of that pivot. So Buddhist studies. Well, it's really more of a full circle than it is a switch. I mean, I bought my first stock when I was 9 years old. I loved reading value line research. This is like 1980, pre-computers, pre-internet, all that stuff. I'd go into my father's broker's office, and on the wall would be all these leather-bound, value line research. And I look at individual companies, and I explore businesses and investments through middle school and high school, and I, ultimately started in finance in college before being totally bored and switching to philosophy and religious studies, and that led me to graduate studies at the GTU in Berkeley, and that's where I sort of dove into Buddhist comparative religion generally, but Buddhist philosophy and Buddhist phenomenology specifically.
Okay, and so how is that tied into your financial services? Because one of the things that your firm does is holistic wealth management.
Sure. So it's actually, so we look at holistic as two different things. Holistic's just a word, right? And we use it in two different ways. First, we look at the whole financial picture. And investments are important, and I think we're pretty good at that piece of the picture, but there's really just a small part of a family's total financial picture. You got to think about debt. You got to think about, spending. You got to think about kids and raising them around money and what's the best way to do that. And you got to think about technological difficulties.
Yeah, it's the weirdest thing. So we use Ring Central, and for some reason it switched the call to a different device, but I have no clue what other device it would have switched it to, because the only one I have it on right now is my laptop. So yeah. So sorry about that. I apologize. And so let's go back. We'll go ahead, edit that.
You're discussing holistic wealth management.
Yeah. So we were just getting into holistic wealth management, if we can get back into that.
Sure. And do you think it recorded that, or do you think we should just go back and ask the question again, and we'll go from there?
It recorded it. Okay,
cool.
So yeah,
and I think I paused nicely at the end of it so that you can cut it.
Yeah. Okay. So yeah. Holistic wealth management. Why don't you explain a little bit more about that? One of the things I did see one of the videos on your YouTube channel, and you did discuss about one of the issues in the financial services industry is that many of the wealth management firms really focus on how to make money first before making decisions for their clients, where you're focused on the opposite. You're looking for the best interest of the client before really trying to focus on how your firm can make money.
I think those two things go hand in hand quite a bit. But yeah, if the clients don't do well, right, we don't do well. And I think that's how business should work. I think that we should do good in the world, and then we can do well by doing that good in the world. I think those two things follow. But I think the specific thing you're talking about is in my industry. And actually this is 2 weeks ago, 3 weeks ago, this entire thing was completely muddied. The water was muddied by an SEC regulation called the best interest contract. So for 30, 40 years, there's been an argument between brokers who represent a product, and they try to sell that product, and they have to meet a suitability standard. So the products they sell have to be suitable for their clients or their customers. And advisors who have to meet a fiduciary standard. And that fiduciary standard is the one that we live up to, other RIAs live up to, CFPs live up to. RIA is Registered Investment Advisory Firms. CFP is a Certified Financial Planner. And that fiduciary is what I think a customer, a client, a person seeking support should absolutely list as their number one priority to the person, for the person they're talking to get advice from somebody. Because you want somebody that's looking at the whole picture. You want somebody that isn't representing a product, they're representing the client. And looking at, hey, if this were my brother or my sister or my mom or my dad or my uncle, what would I recommend would be the best thing for them? And, that means you got to get to know everything about them. You got to know all their cash flows, all their assets, all their liabilities. You got to know everything about them so you can give them really good advice. Whereas on the broker side, you just have to make sure that the product, is suitable. Like it's good enough for somebody like this person. You don't have to know all the details. You just got to know enough. And what the change in the rules, as of like 2-3 weeks ago, they don't actually go live, I don't think, until June or July of 2020. But the change in the rules are people like myself will no longer be able to separate ourselves, in commentary or in conversation by saying we're fiduciaries. What the rule says is we all have to talk about ourselves as acting in the best interests of our clients. They call it the best interest contract. And so I think this just opens another chapter in a very long battle between brokers and fiduciaries. And I think this battle is going to continue for some time. But right now, you really, as a end user, somebody that's looking for somebody to help them, you really want somebody that is looking out for your best interests all the time, gets to know you very, very well, and can answer the questions specifically to your end goals, not product specific.
Mm-hmm. And it seems like this would be a very good thing, right? And it's shocking that this hasn't come about earlier.
Well, there's deeply entrenched interests. You think about, the brokers of the world. We're talking, if you walk into a Wells Fargo or a Bank of America or any of these big banks, Chase, name one, or if you walk into a Morgan Stanley or I guess Merrill Lynch is now Bank of America, or a UBS, or you walk into any of these brokerage offices, they really want to be perceived as looking out for the best interests of the client. But I was trained at some of these, and I was taught basically how to pitch a product. And I just think that, and don't get me wrong, there are really good people that work there, and I have friends that are brokers, and I actually trust them. They can take care of my children. I think they're good people, but the incentive structure just allows for things to go wrong. And so you want to have the incentives aligned to support and benefit the client, for the legal responsibility to be to benefit the client. And that's, you'd think it'd be resolved, but there's massive entrenched interest, and there's so much profit on the brokerage side that it's going to be very difficult to really bring it back to the fiduciary world completely.
I guess one of the most recent movies to really display the corruption is Wolf of Wall Street.
Yeah, I mean that's really
extreme, right?
That's a really extreme example of a chop shop, right? There are, if you go into, your broker at Wells Fargo isn't going to do that to you. And those people exist, and I've gotten those calls. I know those people are real, but that's a really extreme example. I would not worry as much about those things. I mean, I worry about the things that have cover in our normal everyday world. Because, if I get a call with somebody saying, I got this $2, thing you got to get on right now, I know that's a high pressure sale. Pretty much everyone knows that's a pretty high pressure sale. We know that that's probably not good. But if I walk into my bank branch and they say, hey, here's this product that I think you should invest in, and they're a broker, and I don't know they're a broker, and I don't really understand the difference between a broker and a fiduciary. I just trust them because they're my bank. That's not serving the client. And I've had clients that are clients of ours that come in and say, yeah, you know what? I got this great quote unquote savings account at my bank. They noticed that my interest rates are really, really low, and they said, just if we can just transfer that savings account over into this thing right here, then you'll get a better interest rate. So I got this great savings account. What do you think? And I look at it, I go, oh, you bought an annuity. And they didn't even, no one said it was an annuity. No one talked about it as an annuity. They just said it was a better interest rate. And so people, if you don't, peel back the onion, then you don't know. And people don't generally know the difference between the fiduciary and the broker. It's a rough area, and it's going to get, that battle's going to keep going on for years.
Now, one thing I've noticed with a lot of new clients coming into our company with real estate assets to manage is that they not only have real estate assets, but they have stocks, they have other investments, but they self-manage it. So what are some of the commonly overlooked things that you've noticed with people who self-manage their own portfolios?
So commonly overlooked. What do you mean by commonly overlooked?
It could be something that they're missing when managing their own portfolio. A mistake.
Yeah. So I think the challenge is that they're like 95 to 99% of the messaging we receive about investing or money and economics and personal finance is marketing. And it isn't so much that we overlook things, it's that we pay attention, the things we pay attention to don't support better outcomes. This goes for my clients. This goes for just, talk around the water cooler. This goes for, when I go pick up my kids at school and some people ask questions. they ask questions like, what is our president, whether it's 5 years ago or today, what is our president going to do to the economy? They ask, what do you think the economy is going to do in the next, 3 months or 6 months? They ask about specific companies or specific company details, or they ask about whatever their pet indicator might be. They might say, what do you think about the latest unemployment number? Or what do you think about GDP or whatever? And I think that, the tendency to focus on these things without having a financial plan in place, without analyzing your trade-offs, without knowing the things that if I pursue this thing, I will end up happier with a more fulfilling life rather than spending my resources on this other thing. Without doing that front analysis to my values and to creating a financial plan, we actually don't know the trade-offs we're supposed to make. And if we don't know the trade-offs we're supposed to make, we are inevitably going to overspend. And by overspending, we're borrowing from our future selves. So I think it's not maybe it is overlooking. We overlook the planning portion, and then we overlook the sort of the financial science. People generally don't like diversification. People like to be in the thing that provides the greatest reward.
Or the latest trend too.
What's that?
Or the latest trend too. I mean, I notice a lot of people, an article comes out and all of a sudden they want to jump into it and into that type of investment. Exactly.
Bitcoin. Yep. Whereas if you plan and you actually build a long-term portfolio, you're not making those trading decisions. You're not, jumping in or jumping out. And I think people are way better off that way.
Now,
both long-term financial outcomes and happiness outcomes.
Now, does your firm focus on active daily investing, making quick decisions, getting in and out of investments, or are you focused more on long-term passive income?
So I actually think the active versus passive question gets way more ink than it deserves. The question really isn't about active versus passive. It should be about cheap versus expensive. So it's generally true that passive is cheaper than active, but there are active funds out there that are less expensive than many of the new passive ETFs. And even more important, there are variables that are more important to the long-term outcomes than this active or passive question. The variables are things like portfolio construction and behavior, right? So I think active passive is a question that, if you just Google active versus passive, you'll find, probably millions and millions of hits. And you'll find millions of opinions, and you'll find active managers saying, no, active still works. And you'll find passive managers saying, no, passive is the way to go. And I think that's the argument between those two is relatively, it's a rounding error. I think you need to think about appropriate portfolio construction and then behavior.
So what's a typical process for a new client that comes into your firm? What are you initially looking at in building a strategy for them?
So when someone comes to, so we get about, 50 or 60 referrals a year, and we probably take maybe 15 new clients a year. And we have a very rigorous onboarding process. It's not so much about, we don't get to investments or tool selection until, long after we get to know them. Our process is one like this. Somebody calls and says, hey, we're interested in working with you guys at DeYoe Wealth Management. We say, that's great. Thanks for the call. The first step is to talk with one of our associates. Usually that's Scott, and people call and they talk to Scott and they have a conversation. They get a chance to ask Scott some questions about what we do. Scott asks them some questions about who they are, what they're looking for, and we're starting to figure out if there might be a fit between what we do and what they want. If they're saying things like, I want to have a better timing strategy, we know that we're not the right firm for them, and we're going to refer them to somebody else. If they're saying something like, I have all this debt overhang and I don't know what to do with it, and I don't have any assets to cover those debts, we're gonna say we don't really do that. We're too expensive for what you're looking for. We're going to refer them to somebody else. If we think there might be a fit, they're planning oriented, they're goal centered, and they kind of know what they're looking for from an advisor. They want a fiduciary, they want a partner in this whole process. We'll actually send them out a document that's about 10 or 12 pages long and say, here, qualitative and quantitative. Here, send this back to us, and when we get it, we'll set up a time to sit down face to face, and we'll start seeing if we are a good fit philosophically to work together. And if we're a really good fit after that meeting, we're going to call and say, hey, we think we're a great fit, and we'd like to sit down and talk with you and start developing a financial plan for you. And that's where it starts with us. If somebody's a good fit, then we're going to start with financial planning. And in that financial planning process, it is forensic. It's rigorous. We're going to, we ask people to deliver us, 12 months of their bank statements. We ask to look at all of their benefits packages at work. We ask to see all of their investments, all of their debts. We ask them to see, to think through, how old are your kids? Are you thinking you want to support them 50% or 100% for 4 years of college or 6 years of college, or do you think they'll get a PhD? We're going to ask them to think about all their milestones, and then ultimately, what sort of retirement income they want to live on for the rest of their lives, so they don't have to worry about it, and then what kind of legacy they want to leave. And we're gonna put all that information into a digital plan that we can print out if they want to see it printed out, and then and only then will we start investing, because now we know what we're investing for. We know how much risk we should take. We know what their return needs are to fulfill the plan. We know the tax needs that we're going to have to think about for this couple or this family, and then we know what sort of investment tools we should elect to use for them. So it starts actually with a very comprehensive planning process.
So now, for the average person, how often should they be reviewing financial planning and goal setting?
That's it's a good question. So how often should they be doing this? Well, so when we meet with people twice a year. And twice a year we go through and do sort of a deep dive into everything in their financial plans. And I think it's a good idea to look at your financial planning values and the goals and keep those in front of you all the time. In the book, Mindful Money, there is a chapter that ends in a one-page sort of life vision. So I did mine. I printed it out. I laminated it. It sits on my desk. I pick it up and read it pretty often. So I think it's important to keep those goals and the things that are really important to you to try to accomplish front and center all the time. But we do an in-depth plan review twice a year with clients. If someone's doing it on their own or with their partner, I think that they ought to go through this at minimum once a year. And if they don't have a plan or they haven't actually gone through a planning process, then actually reading the book, Mindful Money, there's exercises at the end of every chapter. If you go through the book and do those exercises, by the end of the book, you end up having a financial plan. I mean, the book was originally written for folks that would never be our clients, folks that want to do it themselves or want to go through or aren't ready for an advisor or have these issues with debt or these other things they want to get out of before they start thinking about working with an advisor. So the book was actually intended to reach a wider audience than I can serve as clients. And I think that's a great tool to develop that financial plan and then to review the financial plan on minimum an annual basis.
So let's talk about your book, Mindful Money. And for the listeners, you can go onto Amazon and purchase it there. We will include a link to the actual book in the description for the podcast. What was the motivation?
That's great.
Yeah. And what was the motivation behind you writing the book if the goal was not to, if you wrote the book not for your own clients, I mean, what was the motivation behind that?
So my clients have read it and they love it and they all got a copy, right? That's great. But the motivation was actually this. So in the depths of 2008, 2009, you might remember that Great Recession, I was meeting with a client and she's an author and she was asking the question, do we contribute to the retirement program this year? This might have been, February, March of 2009. Could have been, I don't remember exactly. It could have been late 2008. But it was right there in the very depths of things. And she was nervous. And I couldn't tell her when things were going to turn around or how things would look in a couple of years. But I basically shared, in a long story form, an absolute belief that the up and down were two sides of the same coin. That yes, this is horrible, but this is going to average out with other years to look, when you look back at this will look normal. That the money she invested that day or that she put to work that day would probably be, in the next 10 years, the highest returning money she could possibly put together. Because she's buying low at that point, right? I couldn't, no one could know when or how it's going to get better, but I believed that it would. And my evidence was just all of history. And at that point she said, if I wrote a book, she'd write the foreword. And it took me, 7 years to write it, but when I did, she did. She wrote the foreword, and that was the motivation for the book. And ultimately, like I said, it's a book that can help anybody create a financial plan. And I've had clients say it's a really good mix of finance and then humanity, because really the point isn't. I mean, there's a step before planning, and the book goes into this. There's a step before planning, and that step before planning is really understanding what's important to an individual. And when you go to an advisor and you talk to an advisor about investing, they're going to talk about, which stocks and bonds and funds and their algorithms and how great they are and all that kind of stuff. That is what most advisors talk about. We're focused on having really good financial, but also personal outcomes. And to get to really good personal outcomes, you got to understand the person first. Personal finance is more personal than finance. And so that's why the book is written, is to get that message to a broader range of people.
Yeah, money tends to be a huge stress for many individuals. And I think one of the things lacking is just the lack of proper financial education in middle school and high school. And I guess what's amazing now about the internet is even young kids have access to that information through YouTube and through Udemy and other websites like that. But it still seems like a lot of people are just lacking financial education. So it's amazing that you actually put this book together. So we'll have the link in the description for the listeners to purchase the book on Amazon. And now I have to ask you this question. What's your crystal ball say about the next recession and the current U.S. economy?
Yeah, that's a trap right there. But I'll go for it. So I'm actually doing I do twice a year. I stand up and do a presentation for clients, 50 people in a room, and I do a presentation maybe 45 minutes, and then we do Q&A for 15 or 20 minutes. So I'm actually prepping for this, and this is a lot on my mind right now. So let me start with this. Things are definitely slowing down, but I think that they're slowing down from a sugar high, right? So the tax cuts were passed, and companies all started licking their chops. I thought this was great. We're all going to make a lot of money, and we're not going to pay as much taxes, and that's going to be fantastic, and that's all going to go to the bottom line, and that's going to be great. So we had a few quarters of really high growth. First quarter this year, we came in at 3.2%. That was a sugar high. And the minute we begin, so things are slowing down, the minute we begin talking about tariffs or those sorts of things, companies they refrain from investing. So there's a few parts, or 3-4 parts of GDP that are really important. The first part of GDP that's important is investment spending. That's companies, building plant and equipment. Another part is inventories. Another part is consumer spending. So let's look at those 3 parts very quickly. And if you think about inventories, first quarter this year, inventories went up, which means companies ordered a bunch of stuff and had it shipped to us, so that it was on their shelves to get in front of the tariffs. They wanted to, just in case a tariff war really unwound and became a big deal, they wanted to make sure they had all these goods on their shelves. So that boosted inventories, which boosted GDP in the first quarter, which almost is always followed by a slowdown in the following quarter. When inventories do that, inventories shift back and forth pretty quickly. Second part is investment. Now, if think about it, if you're the CEO of a company and you're going to build a plant that manufactures product X, and you're thinking about maybe putting that plant in the Far East or maybe United States, we're not sure where we're going to put it, but you're thinking about it, and now there's this tariff question. Do you move forward and build a plant not knowing what the tariff's going to look like, or do you wait and see? And I think the obvious answer is you wait and see. You're not going to invest tens or hundreds of millions of dollars in plant and equipment when that plant and equipment may then be subject to a 25% tariff. So the investment part of GDP is down, and it has never really done well since the 2008 Great Recession. But it was getting better after tax cuts, but now it's going to be down this time around. And the last part is consumers, and consumers are actually doing very, very well. And that consumer portion is we're going to see a big upside on that. So we're definitely seeing slowing, and the base case though is still that slow plow horse economy. The base case isn't recession. Now, could we see a recession? Maybe a 10% chance in 2019, maybe a third, maybe a 25% to 33% chance in 2021. Lots can happen between now and 2021. Who knows? But barring a system shock, it feels to me like really slow, agonizingly steady growth. It doesn't feel recessionary to me.
Well, that sounds a lot more positive than many of the headlines out there in the news right now that are screaming that we're going to have some kind of liquidity crisis, some kind of crash coming in 2020, and companies need to begin, correcting in 2019.
Yeah, bad news is good copy. I mean, bad news is good copy. That's how you sell advertisement. Is you get people to pay attention as you take the worst possible scenario and you spin that out as much as you can. We in June of this year, we established the longest expansion ever, and that's what they're saying. Oh, it's long in the tooth. It's long. It's long. It's long. It's long. But the growth has been so anemic and so slow that the cumulative expansion is definitely not setting any records. Like we're not even to the 50% mark for many expansions because we've grown so slow, and we've had fits and starts, and so these things, recessions or expansions don't die of old age. Expansions are killed, and they can be killed with tariffs. That can be something that does it. I think most economists see us coming in with some kind of an agreement at some point. I think there's an argument that the president is sandbagging. He's trying to. There'll be a miraculous agreement. Maybe 9 months before the election, and the economy will take off. It'll be great. It'll be wonderful, and then that's a way to get reelected. And at the same time, the Fed is saying, hey, you know what? We'll find out end of this month. Are we going to cut by 25 basis points, or are we going to cut by 50 basis points? And if they cut, no one isn't buying a house because rates are too high. No one isn't investing because rates are too high, but that gives confidence. That will boost confidence, and that will probably send risk assets up again. So we have the tools to deal with the slowing, and all we're seeing is just a slowing. We're not seeing negative. We're seeing slowing.
Okay. Yeah, that's very good news. And I think the fact that we've gone through the longest expansion is what's scaring a lot of people. And in most people's minds, they're thinking of something similar to the most recent recession, 2008, and thinking, okay, if we're bound to hit something that bad again, if we've had it good for this long. But if we haven't even reached the 50% mark when you're looking at the overall picture, I mean, that's really good news, because that means there's a lot more potential for further growth. There was an economist that told me one time that economies always want to grow, grow, grow. However, a recession happens because of something that just got stuck in there that just caused it to come to a complete stop and a pullback. But for the most part, an economy naturally will always want to grow. So that's actually very good news to hear. That, I mean, if we're only looking at 30% chance of a recession, 2020 is very good. And you make a really good point with what if, the politics play into the whole tariff game and the trade wars, and 9 months right before the election, an agreement comes together. So that's very interesting, very good information. So Jonathan, I want to thank you for being on the podcast. This was a lot of really good information, and we'll go ahead and link up your website, the company's website, and also Mindful Money. People can purchase it on Amazon. And thank you again for being on the podcast.
Thanks for having me, Marc. This is good.
Yeah. And look forward to doing business with you at some point in the future. So have a good day. It's actually beautiful weather today in the Bay Area. So if you can get outside, get some fresh air.
No question. Thanks, man.
Okay. Take care.
All right. Bye-bye.
Bye. Thank you so much for listening to the podcast. Thank you to our producer, Sam Lemon. Please subscribe, like, comment, and share the podcast. Remember, you can listen to the podcast on iTunes, iHeartRadio, Google Play, SoundCloud, and anywhere else you listen to podcasts.